Welcome back to Smart Investing Made Easy. In this video, we're diving deep into one of the most reliable income-generating strategies in the stock market, covered calls. We'll walk through sections 3.0 to 3.9 step by step. So by the end, you'll know exactly when and how to sell covered calls like a pro. Based on the book Smart Investing Made Easy by Steve Goldendale, a covered call is a two-part strategy. You already own the underlying stock, and you sell a call option against those shares. You keep the premium as income, while agreeing to sell the stock at a set strike price if it's reached before expiration. Before we go on, let me remind you of the terms and abbreviations used in the book. Refer back to this table and be familiar with the terms such as CC for covered calls, IV for implied volatility, etc. Also, don't forget to use the flowchart for an overall view of the covered call process. Feel free to pause and rewind if necessary. Let's start with shares you already own through a previous cash-secured put assignment. Say you were just assigned 200 shares of NVIDIA at $98, and now the stock closes a little lower at $96, about 2% below your strike. The next trading day, you can sell two covered calls at the same $98 strike and collect a premium similar to what you received from the puts. If, however, the stock closes 5% or more below your strike, let's say $93, premiums may be too small. In that case, wait until the stock climbs back above the 20-day moving average before selling calls. Sometimes you expect a strong rebound. Indicators such as stochastics, RSI, or MACD show an oversold condition. Wait for confirmation of that upward trend before writing the covered call. Patience here can pay big dividends. You can also write covered calls on stocks you already own in your portfolio. First, check implied volatility for ideally above 40%. If IV is lower, you can sell the covered call now while planning to rotate into higher IV stocks. Or use a modified covered call strategy if you prefer to hold the stock long term. Modified covered call strategy will be explained in more details later. And remember, each option contract represents 100 shares. If you own 55 shares, consider buying 45 more so you can sell one full contract. Next, load a 12-month daily candlestick chart with Bollinger Bands. Before placing any trade, confirm that the body of the candlestick, the open to close range, sits above the 20-day simple moving average. That's your visual cue for a potential covered call setup. Assume NVDA trades at $116.14. You select the $132 strike price as your profit target. The stock can rise $15.86 or about 13.7% before assignment occurs. You sell to $132 call options, collecting a $776 premium, $388 each. That means you profit both from the premium today and any price appreciation up to $132. Modified covered call strategy. If you hold long-term shares in a taxable brokerage account and don't want to risk being called out, lower your delta. Using 0.15 or 0.20 delta instead of 0.30 reduces the chance of assignment. You'll get less premium, but you preserve your position and avoid triggering capital gains. Always consider buying back your sold call when it's gained 50% or about a week before expiration. Use stochastics, RSI, or MACD to fine-tune timing. In a 401k or IRA account, covered calls can be even more powerful. Because earnings are tax-deferred, you can compound profits without immediate tax consequences. While these accounts have withdrawal limits, they're ideal for systematic, low-risk income strategies like the options wheel. Winning scenarios? Out of 4 possible outcomes, you profit in 3. 1. Stock rises above strike, assigned at profit. 2. Stock trades sideways, you keep premium. 3. Stock dips but stays above cost basis, you still win. You only lose if the stock falls below your cost basis. Consistent small wins add up, and that's what makes this strategy so powerful. Key takeaways. To recap. 1. Follow your trade criteria, IV greater than 40%, 0.30 delta, 30 to 45 days to expiration. 2. Use the 20-day SMA, 2-time entries. 3. Manage patience and emotions. Covered calls offer steady, repeatable income and peace of mind. If this helps simplify the process, don't forget to like and subscribe to this channel. Thanks for watching, and may your next trade be another confident, smart investment. Check out this book on Amazon, available now.